The candlesticks are printing faster than your thoughts. News just dropped. The 5-minute chart is spiking, spreads are widening. Your trading view alerts are firing. You've got your setup. Price taps a clean support, bounces with volume. The 1-minute candle closes strong. Your plan says take the long, risk 1R, stop loss below the wick, partial at 2R, but you don't click. Instead, your brain starts spinning. What if this is a trap? What if they stop hunt me? What if I can't take another loss today? In 10 seconds, you've gone from trader to philosopher, but the wrong kind. You're not examining truth. You're negotiating with fear. By the time you finally hit buy, the move is half gone. Your stop loss is too tight, your size is too big, and now every tick against your position feels like a personal judgment. When it tags your stop, you rip it off the chart, flip short, and start revenge trading. That was my reality for a long time. I knew chart patterns. I could recite candlesticks like vocabulary. I'd read all the trading books, memorized risk-reward ratios, watched endless strategy videos. But my P&L still looked like a heart monitor, spikes, crashes, and a slow drift downward. The missing piece wasn't another setup. It was philosophy, not the abstract stuff people sleep through in college. The kind that forces you to ask, what is actually in my control? What is the nature of reality here? Who am I when reality doesn't care about my feelings? Day trading is a brutal philosophy exam. Every candle quietly asks you, what do you believe about uncertainty? Who are you when you're wrong? What do you really control here? Most traders never answer those questions. They just click. That's why most traders lose money. I didn't start improving when I found some secret indicator. I improved when I stopped treating the market like a slot machine and started treating it like a mirror that shows my beliefs back to me. That's what this video is about. How philosophy became the missing piece in my trading psychology, and how it turned Marcus from an impulsive gambler blowing up accounts into a reformed gambler who trades with calm discipline in the same markets that once destroyed him. This is not financial advice, it's a way of thinking. Past patterns never guarantee future results. Trading is risky, and risk management is survival. With that clear, let's step into the mind of a trader and see what happens when you rebuild it on philosophy instead of fear. For years, my trading was built on childish philosophy. I believed good actions deserved good outcomes. If I followed my rules enough, the market owed me a winner. So after 3 losing trades, my brain screamed, it's my turn now. I'd up my size, tighten my stop, and force a setup that wasn't really there. That's how entry hesitation turns into revenge trading, a fairness story colliding with randomness. I believed pain should stop when I decide. So when price came close to my stop, cortisol hit my bloodstream. My chest tightened, and instead of letting the stop loss do its job, I'd drag it further away. That's stop loss removal syndrome, refusing to accept that pain is the price of playing. I believed more information meant more safety. So I added indicators, Twitter feeds, Discord alerts, more screens, 10 different time frames, 100 different opinions. I started hallucinating patterns on random charts just to feel in control. That's classic chart pattern hallucination. Telling yourself certainty is only one more indicator away. Underneath all that was one central bias. My brain hated randomness. Mark Douglas wrote it plainly. If you can't accept that trading outcomes are random in the short term, you will distort everything you see to avoid psychological pain. The disciplined trader warned that when your self-worth is tied to each trade, you'll do anything to avoid taking a loss, including blowing up your account. Steenbarger added the performance angle. Your emotional reactions are signals about how your brain is handling risk. Mine were screaming. Every green position, even a tiny scalp, lit up my dopamine system. The P&L turned into my drug. My brain learned, click more, feel better. So instead of waiting for A setups, I chased the feeling. Every red position pumped cortisol through my body. The longer I sat in drawdown, the more my nervous system screamed, get out or fix this now. So I'd cut winners early and hold losers too long. During fast volatility, adrenaline took over. Fight or flight. I either froze or spammed market orders. No probability thinking, just survival mode. And thanks to social media, my mirror neurons copied other traders. I bought when they bought, panicked when they panicked, and let their emotional state overwrite my own reading of the chart. Here's the paradox philosophy exposed. The tighter I tried to control each trade, the more out of control my equity curve became. The more I demanded comfort, waiting for perfect, no-brainer setups that couldn't lose. The more pain I created, because those were exactly the trades I oversized and refused to cut. The more analysis I did, the worse my results got. More screens, less clarity. I had read all the classic paradoxes. Perfect setups still fail often. The best trades usually feel uncomfortable. Tighter stops can mean bigger losses when you get chopped out of valid ideas. More screens can mean less focus and more FOMO. On paper, I agreed. In real time, I fought them. The breaking point came on a Thursday. Marcus, the version of me will follow, had built what he thought was his breakthrough system. Volume profile, VDWAP, pre-market range, moving average confluence. He'd taken 3 small losses that week and felt like the universe owed him. The open was wild. Price pushed into resistance, rejected, and pulled back. On the 1-minute chart, a bearish engulfing candle printed right at his level. It was his A+ short setup. So he went huge. Risk wasn't 1R, it was 4. He tightened his stop loss to maximize reward, placing it just above the wick. The trade instantly moved in his favor. Dopamine hit. He started mentally spending the money. Then the market did what markets do. It wicked a little higher, tagged his too tight stop by a couple of ticks, stopped him out, and then dumped in the original direction without him. Plan gone. His idea was right, his execution was trash. Biggest loss of the week. Cortisol flooded his system. His brain shouted, "Unfair! They hunted my stop. I was right. I deserved that move." So he did what gamblers do. He removed the next stop. He doubled size on the next signal. He averaged into a bad position, telling himself, it has to come back. The 5-minute chart trended calmly against him. His P&L bled. His breathing got shallow. Palms sweating on the mouse. Eyes locked on every tick. By noon, he had broken every rule he claimed to have. Daily loss limits smashed. Max trades per day ignored. System totally abandoned. Same story, new day. Huge drawdown. Tuition paid to the market again. That night, instead of asking, what's the next indicator? Marcus finally asked a different question. What do I actually believe about this game? He realized he wasn't just trading price. He was trading his philosophy of reality. And his philosophy was wrong. So he started over from first principles. On a blank page, he wrote 3 lines. The market is not a person. It doesn't know me or owe me. Each trade is one event in a random distribution of outcomes. The only things I truly control are my position size, my entries and exits, and whether I follow my rules. That was the beginning of the reprogramming. He grabbed an idea from Stoic philosophy, the dichotomy of control. Above his monitor, he drew 2 columns. Left side, what I control. Risk per trade, stop loss placement, entry logic, exit logic, screen time, preparation. Right side, what I don't control. What the next candle does. Whether this trade wins, news spikes, stop hunts. Other traders' opinions. Before each session, he looked at that note and asked, am I about to obsess over the right column or act inside the left one? Then he redefined what a good trade is, using the logic from Douglas and all the pros in Market Wizards. A good trade was no longer one that makes money. A good trade became entered exactly where the setup said, not where it felt safe. Sized according to plan, not to emotion. Cut at the stop without dragging it. Managed according to predefined rules, not minute-to-minute panic. He started journaling every position with 2 separate grades. Outcome, win, loss, scratch. Process, aligned with philosophy, or not. Patterns appeared fast. His biggest winners often started as the most uncomfortable entries. His worst days came from trying to feel safe first and think later. So he flipped the goal. The goal stopped being, feel good in this trade. The goal became, act in line with my philosophy so my equity curve can feel good over 100 trades. Next, he dealt with his biology. He accepted that dopamine, cortisol, and adrenaline are standard equipment. He didn't try to eliminate emotion, he tried to work with it. He wrote rules around his chemistry. After a big win, when dopamine made him want to go one more, bigger. That was a mandatory break. Step away, breathe, write one line. My brain is chasing a feeling, not an edge. When he felt cortisol, tight chest, anger at the screen, urge to move stops, he auto-reduced risk or flattened everything. No new entries until he could take 3 slow breaths without shaking. When adrenaline surged during high volatility, he cut clutter. Fewer tickers, fewer timeframes. One instrument, one time frame, one setup. Narrow spotlight instead of stadium lights. He took a page from Trading Psychology 2.0 and treated emotions as data. Information about his state, not orders to act. Over that emotional framework, he laid a simple, systematic structure for entries, inspired by The Way to Trade and Real Pros. He picked one primary instrument and a couple of time frames. No more chasing every stock, every Forex pair, every crypto pump. He became a specialist. In trend, he traded pullbacks to VU up, or a moving average, with clear higher time frame structure. In ranges, he traded rejections at clearly defined support and resistance. On breakouts, he traded the first pullback to the level with volume confirmation. For each setup, he defined trigger conditions, exact entry location, logical invalidation for the stop, beyond a swing high-low, not in the noise. Minimum risk, a reward. Management rules, when to move to break even, when to scale, when to exit. Then he tested, statistically, in replay and in sim. He watched the ugly part, long strings of losers inside a profitable curve. He let the numbers beat a new belief into him. Losing 5 trades in a row doesn't mean the market hates me. It might just mean I'm living inside the random distribution I signed up for. Philosophy turned those stats from theory into something he could actually stomach. Slowly, Marcus became a true reformed gambler. His desk looks almost boring now. 3 monitors, but minimal clutter. On the main screen, clean candlesticks, volume, VWAP, a couple of moving averages, marked zones. On another, his broker ladder with predefined tickets that always include a stop loss. On the third, a journal window with a simple prompt. What am I thinking, feeling, and believing about this trade? On the wall, 1 sentence. Act according to your principles. Accept the outcome. It sounds like a quote. It's actually a kill switch for impulsive behaviour. On a typical day, he'll take 2 to 4 trades. He still feels fear on entries. He still feels greed when he's up 2R and sees room for 5. He still feels that little stab when a beautiful setup fails and hits his stop to the tick. The difference is, he doesn't argue with it anymore. He doesn't move stops. He doesn't smash the keyboard after a loss and fire 3 revenge trades. He doesn't jump to another ticker just because someone on Twitter called it. He logs the trade, grades the process, and waits. He understands the real test isn't, can you predict this candle? The test is, can you stay loyal to your philosophy when it hurts? That's what philosophy did for his trading. It made the paradoxes livable instead of unbearable. It turned randomness from a personal attack into background noise. It turned his nervous system from an enemy into early warning radar. Most traders are trying to win the market's game. The ones who last are playing a different game at the same time. They're trying to become the kind of person who can execute an edge over thousands of trades through boredom, fear, greed, and chaos. So if your equity curve looks like a staircase heart monitor, here's your homework. Before you hunt for the next setup, sit down with a blank page and write your own trading philosophy. What do you really believe about randomness? What is a good trade if you couldn't see P&L? What is truly in your control between the open and the close? Then pick one destructive pattern. Stop loss removal, revenge trading, entry paralysis, overtrading. And design one philosophical rule that makes it harder to repeat. A smaller fixed risk per trade, so your ego isn't at stake. A broker-enforced daily loss limit that locks you out. A rule that you must write 1 sentence about your state